Welcome to Manager's EDU. Today, I will cover the EBITDA coverage ratio. I will define it, explain its formula, go through an example, and also clear your concept about what the value of the ratio means. So, let's get started. The EBITDA coverage ratio measures a company's ability to cover its interest payments and principal repayments using its EBITDA. EBITDA stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. It is the profit shown in an income statement before deducting these specific items. So, what does this ratio tell us? It tells us whether the company's EBITDA is sufficient to cover both the principal amount of its loans and the interest on those loans. If the result of the EBITDA coverage ratio is higher, it is a good sign for the company, because it means the company can comfortably cover its debt obligations. If the ratio is lower, it is not a good sign, as it indicates the company may struggle to meet its total loan payments. Now, let's understand where EBITDA comes from in an income statement. In an income statement, we have different elements. First, we have revenue. Then, we deduct cost of goods sold, and we get gross profit. When we deduct operating expenses from gross profit, we get EBITDA, earnings before interest, taxes, depreciation, and amortization. Then, when we deduct depreciation and amortization from EBITDA, we get EBIT, earnings before interest and taxes. And when we deduct interest and taxes from EBIT, we get net profit. So, these are all key elements of an income statement. Now, let's come to the formula. EBITDA coverage ratio equals EBITDA divided by principal amount plus interest expense. Here, the principal amount means the loan amount we have taken from any third party that needs to be repaid, and interest expense is the cost of borrowing that loan. Let's take an example to understand this better. Suppose we have the following income statement for a company called ABC for the year. Revenue equals $1,200,000. Cost of goods sold equals $400,000. So gross profit equals $1,200,000 minus $400,000 equals $800,000. Then operating expenses are $150,000. So EBITDA equals gross profit $800,000 minus operating expenses $150,000 equals $650,000. Then depreciation and amortization are $50,000. So EBIT equals $650,000 minus $50,000 equals $600,000. Then interest expense is $30,000, and taxes are $150,000. So net profit equals $600,000 minus $30,000 minus $150,000, which equals $400,000. Now, for the EBITDA coverage ratio, we need the principal amount of the loan. Let's say the company has a principal loan repayment of $100,000 for the year. So we calculate EBITDA, $650,000, divided by principal amount, $100,000, plus interest expense, $30,000. First, principal plus interest equals $100,000 plus $30,000, which equals $1,30,000. Now, EBITDA, $650,000, divided by $1,30,000 equals 5. So, the EBITDA coverage ratio in this example is 5. Now, what does the value 5 mean? It means that the company's EBITDA is 5 times greater than its total debt obligations, the principal repayment plus interest. In simple words, for every $1 the company needs to pay toward its loan principal and interest, it has $5 of EBITDA available to cover that payment. This shows that the company is in a strong position to meet its debt obligations comfortably. If the ratio were lower, say below 1, it would indicate that the company does not have enough earnings to cover its loan payments. This is a simple but powerful formula for understanding a company's ability to manage its debt. If you didn't fully learn it, you can watch this video again to understand it better. Thanks for watching.